We have a special presenter joining us by Zoom from, I believe, Canada. We have a Dr. Matt Gertken with BCA Research, who's going to talk to us about geopolitical challenges and their impact on investment markets. So with that, I'll pass it now over to Dr. Gertken.
Well, thank you very much. And I happen to be reporting to you from Los Angeles. But yes, BCA Research is based in Montreal, Canada. And what we do is we do macro investment research since 1949. We take a very big picture approach and a data-driven approach. I've been doing geopolitics for 18 years, and geopolitics does meld well with a macro viewpoint on the economy and on financial markets. But of course, it's always a trick translating a geopolitical view to the financial markets. If we think of interest rates as having long and variable lags, well, just imagine geopolitics. For example, Vladimir Putin imprisoned the energy boss, Mikhail Khodorkovsky, and dismantled his company back in 2003. Geopolitical observers knew that this was a signal that Russia was going to take a very different approach to the globalization that was happening, the rise of liberal democracy in the wake of the Soviet Union. But of course, it took many, many years for markets to really price in that story. So what today I would like to talk to you about are the geopolitical risks and opportunities that we see on the horizon. But first, I should just say one more thing about the geopolitical method. So the geopolitical method will look at institutions over individuals. It will really emphasize structural conditions, the geography, the demography, the economic structure, the governmental structure of countries. And only sort of after having taken that structural assessment and then moving on to a cyclical assessment, whether it be the business cycle or the political cycle, whether it be elections or a rotation of leadership in a non-democratic country, only after those things do we look then at the tactical maneuverings of individual politicians, their rhetoric, their ideology. Typically, we tend to underrate ideology and individual personality, and we tend to overrate or overweight the parties, the institutions, the movements, the social movements, and the culture, the strategic culture of a country. This is a very different approach than what you get from the news media, and it is a discipline. Geopolitics is not just a catchphrase, it's a discipline, it's an analytical framework. And I begin with a chart simply showing you of a major geopolitical feature, a major structural feature of the system, which is that the United States is the preponderant power of the system. We know this, but remember that there have been stories for a long time about the decline of the United States on a relative basis. And yet you can see here that in terms of global GDP, the US accounts for 25%, and that has risen since the great financial crisis, since 2012, when it bottomed at around 20%. So productivity in the US and technological advances continue to create a stable share of global economy. And of course, with military output, the US is a militaristic nation. It spends a lot on defense, and in fact, it spends 40% of global defense spending. It may be a little bit less than that because some countries like China tend to underrate their defense spending. Nevertheless, what we have is a feature of the system, which is American preponderance. It's not total domination, not at all. And in fact, we have an anarchic system in which there are other competitors with the United States. When we look at a measure of comprehensive geopolitical power, which in this case is looking at the working age population and then the manufacturing output and effectively manufacturing output per capita, what we see is that the US is comparable to China. China has massively moved up in the rankings because it's grown its economy and of course has a very large manpower base. Also, Europe. Europe has become a unified geopolitical entity. Each crisis in the past 20 years has led to greater cohesion within Europe rather than disintegration like was predicted. And only the UK is an exception to that. And in fact, Brexit has reinforced the cohesion of the EU. So we have three major powers. The US and Europe are mostly allied, and that's for pretty sound reasons. They will have significant quarrels And certainly if President Trump is reelected, we'll have another transatlantic quarrel. Nevertheless, they have fundamental interests keeping them allied. And so when we combine those powers, you have a world system in which the US and Europe and other democracies such as Australia are able to generally create a world order. Now, just to emphasize how fragile this world order is, notice that Russia is at the very bottom of this chart. You almost cannot see Russia, and yet they have managed to destabilize the world system in 2014 and 2022 by invading Ukraine. And so, in other words, remember that when we look at comprehensive geopolitical power on paper, it's not necessarily the same in reality. The US is preponderant, and even though on paper it's comparable to China and Europe, the US has enormous advantages, including its technology, its ability to project power around the world and outer space, through missiles, through its navy, through its submarine power, through its cultural power. Now, the tendency of these great powers, these superpowers, to sort of engage in competition has gone up. And that's especially in the wake of Russian aggression and the divorce between the US and China. And that's motivated by the fact that China did not change its political system, never really intended to change its political system, but it also continued to pursue a mercantilist economic strategy, which eventually provoked the US and now increasingly Europe to take a more protectionist posture. What we see is that foreign direct investment inflows around the world have declined relative to the global economy. And this is important because FDI, foreign direct investment, leads trade. The reason why countries invest in each other indirectly is to build capacity and inventory that will be eventually trade. And we see a decline in FDI, particularly in Russia and in China, where it's virtually collapsed. We also see that global trade intensity, the global imports as a share of GDP has been flat since the Great Recession. And we see in a related development that the United States public opinion is starting to become more skeptical of international involvement. Now, that can be overrated. The chart on the right is showing you, in fact, that about 57% of Americans think that the US should remain engaged in global affairs. So it is still a majority, but it's definitely fallen from the 60 and 70% range that we saw in the wake of the collapse of the Soviet Union and the 9/11 attacks. So now let's dig a little bit deeper into the US election and the US policy in the coming years. So we obviously have a critical election in 2024. Of course, we always say the elections are critical, but in this case, you're really seeing a generational sort of climax because of a rise in polarization that's occurred over the past 40 years. And President Biden and former President Trump represent two factions of the baby boom generation. And effectively, the Democratic Party is looking to redistribute wealth after a huge increase in wealth due to low taxes and free trade over the past 40 years. The Republican Party is essentially the party arguing that redistribution, now under Trump, redistribution should happen, but it should happen through tariffs, basically taxing trade and restricting immigration, and thus increasing the real wages of workers in the US. And those are two different forms of redistribution, whether it's taxing companies and the wealthy or whether it's taxing trade and restricting immigration. That's sort of the choice that voters are facing. We have a quantitative model that you're looking at here that shows Democrats only slightly pulling off a victory in the White House. And some of you are probably thinking, oh, how can that be? Well, this model is pretty good, and it served us well in 2020 as well. But ultimately, I make a judgment. And what that has to do with is the health of the manufacturing cycle. It has to do with the approval rating of the president, how substantial were the president's margins of victory in different states in the 2020 election. What we see is that President Biden is very narrowly hanging on. He's got 277 electoral college votes according to the model. He needs 270 to win. And Arizona is right on the line here. Our model gives it basically 51% chance that Democrats retain Arizona. If they lost that state, according to the model, Biden would fall to below 270 and he would lose the White House. Now, like I said, there's a subjective element here. We can look at opinion polls. They're not looking good for the president. President Biden has a 40% approval rating. If that continues to be the case as voters make up their minds in July and August, then Biden is definitely a lame duck president, a defunct president, and unlikely to win. But normally the president's approval rating would rise as we get closer to the election. Also notice that because the head-to-head polling shows that President Trump is doing quite well in the swing states, it's not at all unlikely that Georgia or Arizona will shift to the Republican camp. And so then Wisconsin or Pennsylvania or Michigan will become very critical battlegrounds. These are manufacturing states. They've been the critical battlegrounds in every previous election since 2008. And the manufacturing cycle around the world is weak. U.S. manufacturing surveys are pretty weak. And so this is also a threat to the president. Finally, we have two other factors. Third-party candidates will tend to detract from the sitting president. If people are voting in a large way for a third-party candidate, it means that they're unhappy with the status quo, and that's not good for the status quo president, the incumbent president. And in particular, Robert Kennedy Jr., if he stays in the race, could win a substantial share of voters, maybe even 3% of the vote. And that would most likely take away from President Biden more than President Trump. Kennedy is a household name for the Democratic Party. Robert F. Kennedy leans to the left on most issues. And even though he's an anti-establishment candidate like Donald Trump has cornered the right-wing populist side of the spectrum. And so new candidates, whether they're center-right, center-left, or far-left, they're going to tend to take away from President Biden. So in other words, what I'm outlining for you is an incumbent president after 4 years, so far no recession. You're going to slightly favor that incumbent effect with a 55% probability, but that's of course low conviction, and we may have to change that view if the unemployment rate rises by more than half of a percentage point in the coming 7 months, or if something else happens that keeps Biden's approval rating stagnant in the 40% or 42% range. The Senate is very likely to go to the Republicans, and that has to do with the rotation every 6 years in the Senate. And so we can draw an important implication right here from the US election. If President Biden squeaks by, he will likely face gridlock in Congress, and that's an entirely status quo situation, and it's basically benign for the financial markets. Doesn't imply any major changes to US fiscal policy. Biden has not shown any inclination to tamper with monetary policy. His trade policy is aggressive, especially toward China, but he's also more measured in pacing that aggression to cooperate with US allies. And so it's a more of a gradual change rather than abrupt or disruptive change. And so effectively, the big risk if Biden wins is that he would double down on the war in Ukraine, and we'll come back to that in a little bit. But other than that, it's a status quo environment, and it's not particularly harmful for investment sentiment. President Trump is different. Many people think that Trump would be bullish for the market because the markets really celebrated when Trump won in 2016. Remember that, first of all, the market often has a relief rally after elections because uncertainty has been removed. But once we get to the inauguration on January 20th of 2025, President Biden's agenda will matter. Now, if he front loads tax cuts and we're in an environment where we've had an increase in unemployment, that too could be bullish. You know, maybe a recession is already priced in at that point, and President Trump is adding stimulus to get out of the recession, and that would, of course, be good for the stock market. But the primary objective of this administration is to raise tariffs and restrict immigration, neither of which are bullish. They're, in fact, negative for corporate profit margins. And what we will see is that the Republicans will be very eager to prioritize restrictions on immigration this time around because they failed to restrict immigration during the first term of President Trump. Over a 4-year period, what this means is that you have an inflationary cocktail in the United States of higher tariffs, larger budget deficits due to tax cuts, and a shortage of labor due to the restriction of immigration. So structurally, this would be a major change for the US, and it would be inflationary, at least on the margin. Now let's go a little bit around the world, both addressing the foreign policy implications of the US election and independent foreign events. First of all, with regard to China, Now, the signal geopolitical risk, of course, has to do with the Taiwan Strait. But before we talk about that, we have to point out something about the Chinese economy. China's economy, the macro backdrop is very negative. You do not see China pursuing the structural measures that would need to be done to encourage animal spirits, to encourage the private sector, households and businesses to spend, to borrow, to have dreams and plans and ambitions that would fire up the economy. You do not see privatization of companies. In fact, quite the opposite. You do not see even the sort of stimulus that investors are hoping for that would provide temporary support. I do think stimulus will increase, particularly in 2025 and beyond, and particularly if President Trump is imposing tariffs, large tariffs on China. But remember that when you're in a debt deflation trap and you're already easing monetary policy and you're already running large budget deficits, according to the IMF, the stimulus will have to be really dramatic in order to accelerate the economy. In fact, it's not really possible to have a major durable reacceleration on stimulus alone. Stimulus is going to push China up to its potential GDP growth, maybe 4 or 5%. But it's not really going to accelerate the economy above that potential GDP growth like it used to do. What you would really need for China to reaccelerate in a persistent way would be an increase in productivity. China's hoping that by investing in science and technology, research and development, that they will be able to generate a major productivity boom. And maybe they will, but it's completely untested. And of course, the US and its allies are going to be trying to restrict China's access to semiconductors, which are foundational to most of the technologies that are supposed to produce that increase in total factor productivity. Now, in that context, Taiwan does not have the same impetus to be subjugated or be attracted to mainland China. China is going to put economic pressure on Taiwan to try to undermine the president, who is nominally a pro-independence president. China will also likely, I think, use hybrid or gray area military activity to try to take small chunks of Taiwanese territory. Now, this will escalate the conflict in the coming years, but it won't be a full-scale war. It'll essentially be some kind of threat to small outlying islands that Taiwan has, meant to signal to the Taiwanese people that they're both losing economic growth because they're not doing what China says, but they're also at risk of losing their territory. And this is supposed to shape a mentality that will then produce an electoral outcome that's more favorable for China in the 2026 and 2028 elections. However, it is an escalation of conflict, and the US will be providing Taiwan with a lot of support, including weapons. And so what we have is an environment where the Taiwan issue will continue to be an adjutant, and it will continue to discourage Western capital from rushing back into China. So in other words, if you're thinking that Chinese equities are cheap and you're wanting to dive back in, I don't think the timing is appropriate yet. I do think that under Trump or Biden, we could have a deal with China. The US and China could eventually create a diplomatic framework where they agree to disagree about Taiwan. Basically, let's not have a war. That could happen by 2026, 2027, if we're very optimistic. But most likely tensions will go up before any sort of major diplomatic achievement like that occurs. And so, in fact, valuations in Chinese equities could continue to have a very high risk factor, risk premium, suppressing the valuation. Now, with the Middle East, what we have are two factors. First of all, Israel. Eventually, there will be a ceasefire in Gaza. Israel will effectively get to a point where they believe they've achieved degrading Hamas's capability. But the Netanyahu coalition will start to fall apart at that point, and Benjamin Netanyahu himself, the prime minister, will come under threat. He will be blamed for not having a reconstruction plan in Gaza. He will be blamed for having allowed the October 7th attacks to occur, despite being a security hawk. And there will be efforts to oust him from power. In that context, he could end up being more aggressive toward Hezbollah in southern Lebanon in order to make room for Israeli citizens to return to northern Israel. And he might wait till after the election if he can, but he might not. And of course, this is speculative, but it certainly is a risk that we should be aware of, that we could have a new conflagration in southern Lebanon. That in and of itself does not impact the oil supply, but it does raise tensions in the region, and it does bring Israel and Iran closer into direct conflict. Iran will definitely support Hezbollah. It's their most powerful proxy group. And ultimately, beneath all of this, if we get beyond this year and we look over the medium term and long term, the driver of the conflict is the Iranian pursuit of nuclear weapons. Iran has enough highly enriched uranium to build 7 nuclear bombs if they want to. And there are debates about how quickly they could develop a deliverable nuclear weapon, but ultimately it could happen within a year if they really wanted to. And that could force the US and Israel to take military action or to take cyber actions and use sabotage, other ways to try to prevent nuclear weaponization. Multiple administrations of both the US and Israel have said that they will not allow Iran to get a nuclear weapon. So we have a blatant contradiction here where the US and Israel have drawn a red line for many decades. Iran is getting closer to violating that line, and yet everyone believes that it's all going to be okay. I think that is a major underrated risk. And of course, what it underpins is that the region itself is unstable. We're not in an environment where the US is negotiating a freeze to the Iranian nuclear program and talking about lifting sanctions, not at all. Instead, we're in an environment where there is no agreement. The US is going to try to contain Iran, especially after the election is over. Russia, Vladimir Putin is having a sort of mission accomplished moment. He's feeling good this year. He's been reelected. Even if he didn't manipulate the election, he still would have been elected, most likely, because he has achieved the territorial conquest in Ukraine for now. And his economy is firing because, of course, they have implemented capital controls and they're manufacturing a lot of machinery and a lot of ammunition. But when we cast our eyes forward in time, what we'll see is that this is going to be a very sclerotic economy. You have a shrinking labor force. You have productivity growth that's been slowing down. There were not structural reforms when times were good, when the oil price was high. You will not be getting investment from Germany and Europe anymore. Effectively, Russia will enter into a very, very dangerous economic decline. That's going to keep Europe spending more on defense. Could be a stimulated factor for Europe to have to rearm because they have a very clear causality that they've observed, which is that internal Russian instability leads to external Russian aggression. Now, in this context, China will continue to grow much closer to Russia, and that is a major reason why the United States will not be able to conclude a really deep new re-engagement with China. Even if they agree not to have a war over Taiwan, the US and China will not be re-engaging their economies because the US, from a geopolitical point of view, cannot funnel capital and technology into China in a context where China is allied with a major commodity power and a major military power such as Russia. So this is the new sort of great power competition that I referred to at the beginning. So now just to wrap up, in terms of the markets, clearly none of the risks that I've mentioned are priced in particular, the fact that under Biden or Trump, we'll have a continuation of the US policy of trying to restrict China's technology. Not priced with these large cap tech stocks being, some of the big winners. And I would just sum that up by saying that this is not the 1990s. There is no peace dividend. The deflation that's coming from China has been perceived as a positive factor, much like the deflation from Japan in the 1990s. But the difference is that China is not a US ally, as Japan was in the 90s. And so the deflation and the conflict, the trade conflict, never posed the risk of breaking out into a geopolitical conflict back in the 1990s, but it does in the 2020s. And so this will eventually have to be priced in some way. And it could simply be priced as a result of the fact that President Trump, within 12 months, there's a 45% chance he wins the election, maybe 55% chance, and he would impose large tariffs. Now, the stock market typically corrects if the if the party is going to change in the US. And so that's an important point to remember as well. The stock market today is saying we have a soft landing. That means the incumbent party should actually do better. We should see President Biden's approval rating improve as we get closer to the election, as I mentioned earlier. But of course, Biden's on very thin ice. So if the unemployment rate starts rising, or if he's humiliated abroad, or if anything else happens that keeps his approval rating sort of low and trailing Trump in the head-to-head polls in the swing states, then we will have markets pricing major policy discontinuity, major policy uncertainty, the fact that the Republicans could win a full sweep and structurally change the US economy. Now, during this period of extreme uncertainty, I think we would want to remain overweight US assets. And I think the market has made that quite clear in US outperformance. That includes a relatively resilient dollar. But over the years, remember that I mentioned that if President Trump and the Republicans win a full sweep, we will have a very inflationary policy mix. And over a 4-year term, that could lead to a big sell-off ultimately for the dollar, for US bonds, for US stocks. So there are serious risks to this US predominance in the markets. But during the period of decision, during the period of uncertainty, and during the period in which conflicts have not been resolved, we will tend to see US assets continue to be safe havens. So thank you for your time, and I'm happy to take questions.
Let's open up the floor to questions. Anybody have a question for Dr. Gertken? So maybe I'll kick us off first. Matt, there's a parallel that I like to draw between the CHIPS Act and also the development of shale, and how the Americans found less interest, so to speak, in the Middle East after becoming sort of energy self-sufficient. Is there a scenario that with the CHIPS Act and the Americans eventually become self-reliant on semiconductors and no longer need Taiwan? Does that change the calculus somehow?
Yes, I do accept that logic that Taiwan could lose its silicon shield because the United States, Europe, Japan, and China are all, investing huge fiscal resources in building their own semiconductor power plants, and so ultimately Taiwan may lose its edge. The only thing I would emphasize is that semiconductors are overrated in this strategic complex. Even aside from semiconductors, the United States views Taiwan as a linchpin of the security architecture in East Asia. In an environment where China could use belligerence to subjugate Taiwan, what we would see is the unraveling of America's strategic posture in the region. Japan would be terrified. They import 90% of their food and fuel, and they would be looking at having to basically ask China's permission to do that. Same with South Korea. It would be a major incentive for Japan to go nuclear. And the United States would find that it would be losing the ability to arbitrate the regional power dynamics. So the US has an interest in defending Taiwan to uphold its credibility, but also to maintain a stable Eastern Hemisphere and ensure that we don't have a total collapse of the status quo, which could lead to another war or to the ejection of US forces from the region. So there's that. And the only other thing I would emphasize is that, of course, both Japan and the United States have repeatedly shown that they are very interested in the defense of Taiwan. So I don't think you can have an easy conflict there. And even if China attempts to do a blockade, remember that in the case of the Cuban Missile Crisis, the United States did not worry that Cuba would attack the American Navy when it imposed a blockade. In the case of China and Taiwan, Taiwan would have the ability to attack the Chinese Navy if it tries a blockade, and that would very likely draw in the United States and Japan. So even aside from semiconductors, I think over the long run, this is a very dangerous situation, and that's why we need a US-China, a durable diplomatic agreement not to have a war over this issue, and I'm not very optimistic.
Very good. Do we have one more question, perhaps? Yeah, got one over here.
What do you think the chances are of the AUKUS alliance lasting under a Trump administration?
Yeah, thank you. And I realize that that's a very important question for Australia. I actually, well, first of all, let's be clear about methodology. I have no idea what Trump intends or what's in his mind, and he's a very erratic policymaker. So, I think it is a risk. I think allies have to be very worried about President Trump because he does have a tendency to lash out at allies as well as rivals. And I think that could be harmful for countries that have sort of adopted American policy initiatives for their own security, but then they could have, that jeopardizes their relationship with China, and then they could have the rug pulled out from under them. So I do think that is an important concern that you're raising. But one interesting thing I've observed about the Trump presidency in the first term, and I think there's quite a bit of evidence behind this, is that his primary objective has been the confrontation of China. So in the case of AUKUS and in the case of Australia and Japan and India, I don't think we have as much of a basis to believe that the Trump administration would be as hostile as we may well see in the case of Europe, where Trump has been very quick to undermine shared initiatives, impose tariffs, and generally turn the tables. So bottom line, I think it's a concern, but the fact is that structurally and from a grand strategic point of view, the US and Japan and Australia and India and the UK, specifically AUKUS, US, UK, Australia, these are countries that share enormous strategic interests, and I think they will be upheld even if there are disruptions. And last point on this, I would even extend that to the question of NATO. President Trump has threatened to withdraw from NATO. Could happen. Charles de Gaulle withdrew from NATO briefly. France ended up back in NATO, and I'm quite sure that the US would end up back in NATO as well. That is not to elide the risks and the destabilization that could happen over a 4-year period, but it is to say that from a geopolitical point of view, the underlying national interests ultimately should prevail. And I think that's very much the case with AUKUS.
Dr. Gertken, thank you very much. That's some excellent food for thought. Let's thank him for his comments today. Enjoy the rest of your day.
Yes, thank you so much. Thank you all.